There is a single fundamental flaw in the human mind that costs people more money, more opportunity, and more happiness than any other. It is a silent saboteur that operates in the boardrooms of Fortune 500 companies and at the kitchen tables of families planning their future. It is a cognitive ghost that whispers affirmations in our ear, telling us we are right, that our first instincts are pure genius, and that any information to the contrary is noise, irrelevant, or the work of fools. This flaw, this deeply ingrained bug in our source code, is called confirmation bias. It is the natural human tendency to seek, interpret, favor, and recall information in a way that confirms or supports one's pre-existing beliefs or hypotheses. Your brain is wired to agree with itself. And in the world of high-stakes decision-making, where capital and careers hang in the balance, agreeing with yourself is the fastest path to ruin. Warren Buffett and his partner Charlie Munger, the architects of the Berkshire Hathaway empire, a monument to rational decision-making, understood this flaw not as a minor inconvenience, but as the primary enemy. They saw it as the dragon that must be slain before any treasure could be claimed. Over decades, they didn't just learn to manage this bias. They engineered a weapon to destroy it. A mental model so powerful, so contrary to human nature, that it has become the central pillar of their multi-hundred-billion-dollar success. The core of this system is a single brutal mandate. To make a truly robust decision, one must actively and vigorously try to destroy their own best-loved ideas. You must become the lead prosecutor against your own case, the most fearsome critic of your own creation. You must seek out disconfirming evidence with the same fervor a gold miner seeks a glittering vein. This is not about being pessimistic. It is about achieving a state of intellectual honesty so pure that what remains after the onslaught is as close to truth as a human mind can get. Today, we deconstruct this antidote to folly. We will explore the 5 pillars of this system, not as abstract theories, but as a concrete, actionable protocol for making bulletproof decisions in your investments, your career, and your life. This is the journey from having a mere idea to forging a conviction worthy of your capital and your commitment. This is the final promise of rational thought. Our first step on this journey requires us to descend into the very wiring of our own minds, to understand the enemy we are fighting. We must dissect the psychology of self-deception and truly grasp the pervasive, insidious nature of confirmation bias. To do this, we must travel back to 1993, a time of relative calm and prosperity in the American economy, and witness one of Warren Buffett's greatest acknowledged mistakes, a mistake born not of faulty math or a bad market, but of a story he told himself, a story he desperately wanted to be true. This is the story of the Dexter Shoe Company. For decades, Buffett had built his reputation and fortune on finding quintessentially American businesses with durable competitive advantages. He loved brands that were woven into the fabric of the country, companies that produced tangible goods, employed thousands of Americans, and had stood the test of time. In Dexter Shoe, based in the proud state of Maine, he saw the perfect embodiment of this ideal. Founded in 1957, Dexter was a symbol of American manufacturing prowess. They made sturdy, reliable shoes, and they did it all within the United States, resisting the siren song of cheaper overseas labor. The company had a strong brand, a loyal customer base, and a history of consistent profitability. To Buffett, it looked like a classic Buffett stock, a business so simple and good that a ham sandwich could run it. He fell in love with the story. He fell in love with the idea of owning this piece of Americana. In 1993, he met with the company's owner, Harold Alfond, and they struck a deal. But this was no ordinary deal. Buffett was so certain, so utterly convinced of Dexter's unassailable position, that he didn't pay with cash, he paid with stock. Specifically, he paid with 203 shares of Berkshire Hathaway Class A stock, which at the time were valued at approximately $16,500 per share, making the total purchase price around $433 million. This was the critical error, an error rooted entirely in confirmation bias. Buffett's pre-existing belief was that a strong American brand with a long history was, by definition, a durable moat. He then proceeded to filter all incoming data through that lens. He saw the history of profitability as a guarantee of future profits. He saw the Made in USA label not as a potential liability in a globalizing world, but as a mark of untouchable quality. He saw what he wanted to see. What disconfirming evidence did he ignore? The world was changing. The tectonic plates of global trade were shifting. The North American Free Trade Agreement, NAFTA, was being negotiated, and other trade barriers were falling. Low-cost manufacturers in Asia and Latin America were becoming formidable competitors, capable of producing similar quality shoes for a fraction of the price. The moat that Buffett perceived was not a deep, wide castle trench. It was a shallow puddle, and it was evaporating under the hot sun of global competition. He knew this. In other parts of his portfolio, and in his writings, he was keenly aware of the impact of foreign labor. But for Dexter, his affection for the story overrode his analytical objectivity. He wanted the narrative of the great American company to be true, so he found evidence to support it, and subconsciously dismissed the mountain of evidence that contradicted it. The result was a catastrophe. Almost immediately after the acquisition, Dexter's competitive position crumbled. Cheaper imports flooded the market. Profits vanished. The company became a financial black hole within Berkshire Hathaway. Buffett himself would later describe the investment in stark terms. He said, "I bought a company that was destined to go to zero, and I paid for it with stock that was destined to go to the moon." The financial consequence of this error is staggering to comprehend. That $433 million, had it been paid in cash, would have been a painful but manageable loss. But it was paid in Berkshire stock. As of today, those 203 shares of Berkshire Hathaway would be worth well over $12 billion. It wasn't just a $433 million mistake. It was a multi-billion-dollar mistake, arguably the single worst capital allocation decision in Buffett's legendary career. And it was caused entirely by the mind's tendency to fall in love with its own conclusions. This catastrophic failure at the highest level of business begs a deeper question: why? Why would a mind as famously rational as Warren Buffett's fall into such a simple trap? The answer lies in the deep, ancient wiring of our brains. Confirmation bias isn't a character flaw. It's a feature of our evolutionary design that has gone haywire in the modern world of complex information. On a neurological level, when we encounter information that confirms our existing beliefs, our brain's reward system gives us a small hit of dopamine. It feels good to be right. It's a sensation of comfort, certainty, and cognitive ease. Conversely, when we encounter disconfirming evidence, it creates a sensation known as cognitive dissonance, a mental stress or discomfort. Our brain has to work harder, expend more energy, and confront the unpleasant possibility that our model of the world is wrong. To avoid this discomfort, our brain takes shortcuts. It acts as a biased filter, actively seeking out the dopamine-releasing confirming data and pushing away the dissonance-inducing contradictory data. Think back to our ancestors on the savannah. If you held the belief that rustling in the tall grass means a predator is near, this bias was a life-saving mechanism. Every time the grass rustled and a lion appeared, your belief was confirmed, and you survived. You weren't incentivized to run an experiment where you stayed put to gather disconfirming evidence. The cost of being wrong was too high. Quick pattern recognition and confirmation were survival itself. The problem is that the modern world is not the savannah. An investment thesis is not a lion in the grass. The complex, data-rich environment of financial markets and business strategy demands nuance, objectivity, and the ability to update one's beliefs. But we are still running that ancient software. This core bias is then amplified by a host of other cognitive errors that hunt in packs. The availability heuristic, for example, makes us overvalue recent or easily recalled information. If a certain type of investment has been successful recently, our minds will latch on to that available evidence and extrapolate it into the future, ignoring the longer-term data that might suggest caution. Then there's the halo effect. When Buffett looked at Dexter Shoe, he saw the halo of a great American company. He liked that one aspect so much that he assumed everything else about the company must be great too: its future prospects, its competitive position, its valuation. The positive glow of the narrative blinded him to the cold, hard numbers. This is why intellectual honesty is so difficult. It's a fight against our own biology. Our brain doesn't want to be right in an objective sense. It wants the comfort and ease of feeling right. It prioritizes cognitive fluency over factual accuracy. It will construct entire narratives like Buffett's story about Dexter to protect a cherished conclusion. The discipline of actively seeking to destroy your ideas is therefore an act of rebellion against your own instincts. It is the conscious decision to choose the discomfort of cognitive dissonance over the false comfort of confirmation. It's about understanding that the temporary pain of proving yourself wrong in private is infinitely preferable to the permanent, catastrophic pain of being proven wrong by the market in public. So how do we begin this rebellion? How do we translate this psychological understanding into a practical tool? The first step is to create a system that forces a confrontation with disconfirming evidence before a decision is ever made. We can call this mental model the confirmation journal, a simple but profoundly effective technique for short-circuiting our brain's biased wiring. Here is the blueprint, a step-by-step process you can apply to any significant decision, whether it's making a major investment, launching a new business strategy, or even making a critical career move. Step 1. Isolate the thesis. Before you do anything else, you must articulate your initial conclusion in a single, clear sentence. For example, I believe Company X is a good investment because its new product will capture 20% of the market. Or, I believe our company should enter the European market to drive growth. Write this sentence down at the top of a new document or a new page in a notebook. This act of writing it down is crucial. It solidifies the idea and prevents you from subtly shifting your reasoning later on. This is the idea you are now committed to destroying. Step 2. The 48-hour moratorium. For the next 2 full days, you are forbidden from seeking out any information that supports your thesis. You are not allowed to read the bullish analyst report. You are not allowed to talk to the colleague who you know agrees with you. You are not allowed to visit the online forums where everyone is cheering for your idea. Your information diet is now strictly limited to contradictory, challenging, and disconfirming evidence. Your sole mission is to find the most intelligent, most articulate, and most convincing arguments against your own conclusion. Actively search for the bearish analyst reports, the articles about the product's failures, the statistics about the difficulties of European market entry. Log every piece of disconfirming evidence you find in your journal, right below your initial thesis. Be specific. Don't just write competitors are strong. Write competitor Y has a 50% larger R&D budget and a patent that could block our product's key feature. This phase must be an active, aggressive hunt for the truth that will make you uncomfortable. Step 3. Argue for the opposition. At the end of the 48-hour period, you must perform the most critical act of intellectual honesty. You must write a detailed, passionate, and well-reasoned essay, at least 500 words, arguing for the exact opposite of your initial thesis. Using the evidence you gathered, you must make the case against yourself, as if your life depended on it. You have to inhabit the mind of your most intelligent opponent. Charlie Munger famously said, "I never allow myself to have an opinion on anything that I don't know the other side's argument better than they do." This step forces you into that position. It rewires your brain to see the other side not as an obstacle but as a valid, complex perspective. Only after you have completed this 3-step process are you allowed to make a decision. What you will find is that in many cases your initial idea will crumble under this scrutiny. You will have successfully killed a bad idea before it cost you anything. But in the rare cases where your initial thesis survives this onslaught, when you can systematically dismantle the best arguments against it, what you are left with is no longer a flimsy opinion. It is a battle-tested conviction. You have earned the right to have that opinion. To truly appreciate the power of this disciplined approach, we must examine its opposite. We must walk the path of the 99%, the well-trodden road of the echo chamber, which almost always leads to a cliff of financial disaster. The antithesis of the confirmation journal is the default mode of human operation in the information age. Imagine a typical investor. Let's call him Mark. Mark hears about a hot new technology stock. Let's call it Innovate Corp. From a friend. He has a flash of insight. This is the next big thing. This is his initial thesis. What does Mark do next? Does he seek to destroy this idea? Of course not. He immediately dives headfirst into a pool of confirming evidence. He Googles Innovate Corp stock and clicks on the articles with titles like Why Innovate Corp is Set to Soar and The Revolutionary Technology Changing the World. He joins a subreddit and a Facebook group dedicated to the stock, where every post is a celebration of minor positive news and every skeptic is shouted down as a hater or a shill. He starts following Twitter accounts that do nothing but post bullish charts and memes about the company. Every piece of information Mark consumes is designed to give him that pleasurable dopamine hit of being right. His social circle, both online and off, becomes a powerful source of social proof. When everyone you talk to agrees with you, your belief feels not just correct, but obvious. Indisputable. This creates a dangerous feedback loop. The more confirming evidence he finds, the more confident he becomes. The more confident he becomes, the more he invests. He might even start buying on margin, leveraging his portfolio, because his conviction feels absolute. But it is a hollow conviction, built on a foundation of sand. He has never grappled with the bear case. He doesn't know the counter-arguments. He is intellectually defenseless. He doesn't know that Innovate Corp's revolutionary technology is built on a soon-to-expire patent, that its CFO has a history of accounting scandals, or that a massive competitor is about to launch a superior product at a lower price. He doesn't know these things because his information-seeking process was specifically designed to shield him from them. Then, the inevitable happens. The disconfirming evidence that he so carefully avoided finally manifests in reality. The patent expires. The competitor's product launches. The stock begins to fall. Mark's first reaction is denial. It's just market manipulation, he tells his online friends. The smart money is buying the dip. But the stock keeps falling. 10%, 20%, 50%. His hollow conviction shatters, replaced by panic. He sells at the bottom, locking in a catastrophic loss. This is not a rare occurrence. It is the defining story of every market bubble in history, from the tulip mania of the 1600s to the dot-com bubble of the late 1990s. Millions of people, caught in a collective echo chamber, confirmed each other's beliefs about a new paradigm right up to the moment of the crash. They followed the path of the 99%, the path of least psychological resistance, and it led them to ruin. This is not just a failure of investment analysis, it's a failure of critical thinking at the most basic level. The financial consequences of this cognitive flaw are not abstract. They are brutally, mathematically concrete, and they manifest directly in the numbers that determine your financial freedom. The cost of confirmation bias is a hidden tax on your wealth, compounding silently against you over time. Let's return to Buffett's Dexter shoe mistake to quantify the damage. He paid with Berkshire stock. Let's consider the direct loss and the opportunity cost. The direct loss was the eventual write-down of the $433 million investment. It went to zero. But the real, soul-crushing loss was the opportunity cost. That stock, which he gave away because he was so in love with his own story, went on to become the engine of wealth creation for those who held it. The 25,203 shares of BRKA he traded for a failing shoe factory would today be worth, depending on the day's market price, somewhere between $12 and $15 billion. That is a mistake of a scale that is difficult for the mind to even process. It is a permanent impairment of Berkshire's intrinsic value, a hole in the balance sheet that can never be refilled. This is the direct financial connection. Confirmation bias convinces you to trade something of immense potential value for something of little or no value because you have fallen for a narrative. On a more personal portfolio level, this bias creates two destructive behaviors that kill returns. First, it causes you to hold on to your losers for far too long. When a stock you bought goes down, your initial thesis is challenged. To avoid the cognitive dissonance of admitting a mistake, you go on a hunt for confirming evidence that it's bound to come back. You average down, throwing good money after bad, all to protect your ego and your initial conclusion. This prevents you from cutting your losses and redeploying that capital into a more promising opportunity. Second, and more subtly, it can cause you to sell your winners far too early. Let's say you buy a wonderful business that proceeds to double in value. Your initial thesis has been confirmed, and you get a huge dopamine rush. The feeling is so good, you want to lock it in. The fear of that good feeling disappearing, the fear of the stock going down and invalidating your brilliant decision, becomes overwhelming. So you sell, taking a quick profit, instead of doing the hard analytical work to see if the company's long-term prospects are even better than you first imagined. You confirm your short-term thesis, and in doing so, miss out on the multi-bagger returns that build true, lasting wealth. Ultimately, confirmation bias is the enemy of compounding. Compounding requires patience, discipline, and the ability to let your great ideas run while ruthlessly cutting your mistakes. Confirmation bias does the exact opposite. It makes you stubborn with your mistakes and timid with your successes. It is a direct assault on the mathematical engine of wealth management, a silent killer that ensures your financial results will always be a pale shadow of what they could have been. Slaying this dragon is not an optional exercise for the aspiring investor or leader. It is the absolute prerequisite for success. The first step in our rebellion against cognitive bias was to force a confrontation with disconfirming evidence, but this is often not enough. Our minds are tricky. They can rationalize away even the most damning evidence if left to their own devices. To build a truly robust decision-making process, we need to go deeper. We need to adopt a philosophy, a fundamental way of looking at the world that is so counterintuitive it permanently alters our thinking. This brings us to our second pillar, the core operating principle of Charlie Munger's mind: invert, always invert. The German mathematician Carl Jacobi was famous for this approach to solving difficult problems in mathematics. He would often say, "Man muss immer umkehren," which translates to "one must always turn back," or more colloquially, invert, always invert. Munger took this mathematical insight and applied it to the messy, probabilistic world of business and life. The principle is simple. Instead of asking how to achieve a desired outcome, you ask the opposite question: what would guarantee failure? What do we want to avoid? Instead of thinking forward to success, you think backward from failure. This simple flip in perspective is one of the most powerful mental models in existence because it bypasses our natural optimism bias and forces a brutally honest assessment of risk. The perfect illustration of this principle in action is the decades-long aversion that Buffett and Munger had to investing in the airline industry. For years, Wall Street analysts and investors would try to make a case for airlines. They would build complex models showing how a small increase in passenger miles or a slight drop in fuel costs could lead to huge profits. They were always asking the forward-looking question: how can we make money in airlines? Buffett and Munger inverted the question. They asked, how could we create a business that is guaranteed to be a terrible, capital-destroying nightmare? To answer this inverted question, they started listing the necessary ingredients for failure. First, you'd want a business with massive, constant capital expenditures. You need to buy hugely expensive airplanes, and they wear out, so you have to keep buying new ones. Check. Second, you'd want a business that competes primarily on price. When a customer is choosing between two airlines for a flight from Omaha to Chicago, their primary consideration is almost always the ticket price, not the brand loyalty. This leads to brutal, margin-crushing price wars. Check. Third, you'd want a business with powerful, contentious labor unions that can ground your entire operation during a strike, demanding a huge portion of any profits you might make. Check. Fourth, you'd want a business that is fatally exposed to a single volatile commodity price that you have no control over, namely jet fuel. A sudden spike in oil prices could wipe out a year's worth of earnings. Check. Fifth, you'd want to be at the mercy of factors completely outside your control, like terrorism, global pandemics, or volcanic ash clouds, all of which could destroy customer demand overnight. Check. By starting with the question of what to avoid, they built a list of characteristics that described the airline industry perfectly. They didn't need a complex spreadsheet to see that the industry was a minefield of unavoidable risks. By trying to understand how to fail, they concluded that consistent success was nearly impossible. As Buffett famously quipped for years, if a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville Wright. He would have saved his descendants a lot of money. For decades, this inversion kept Berkshire Hathaway away from airlines, saving them from the numerous bankruptcies and value destructions that plagued the industry. It was a masterclass in using inversion as a tool for critical thinking and avoiding mistakes. The power of inversion as a mental model lies in its ability to counteract several powerful and dangerous cognitive biases simultaneously. Our brains are, by default, wired for optimism. The optimism bias is the well-documented tendency for individuals to believe that they are less likely to experience negative events than others. We think we'll be the one to succeed where others have failed. We focus on the best-case scenario because it's emotionally pleasant and cognitively easy. We dream of the successful product launch, not the supply chain collapse. We envision the soaring stock price, not the bankruptcy filing. Inversion is a direct assault on this bias. It forces you to stare into the abyss, to systematically list all the ways your brilliant plan could go horribly wrong. It replaces a vague, optimistic feeling with a concrete list of threats. A related cognitive shortcut is the availability heuristic, which we touched on before. Our minds give undue weight to information that is vivid, recent, and easy to recall. Stories of success are almost always more vivid and widely publicized than stories of failure. We hear about the billionaire founder, not the thousands of founders who went bankrupt. We see the headlines about the stock that went up 1,000%, not the countless ones that went to zero. Inversion counteracts this by forcing you to actively seek out and catalog the less available, less vivid information about failure modes. You have to go looking for the corporate autopsies, the stories of what went wrong. Perhaps the most profound application of this is in the business practice known as a pre-mortem. This technique, championed by psychologist Gary Klein, is inversion institutionalized. Here's how it works. Before starting a major project, the team gathers in a room. The leader looks at them and says, "Imagine it's a year from now. We are looking back, and this project has been a complete and utter disaster. A total failure. Now, for the next 15 minutes, I want everyone to write down every single reason why they think it failed." This simple exercise is psychologically brilliant. Instead of asking people to criticize a plan, which can feel confrontational and risks triggering groupthink, it liberates them to use their imagination. It bypasses the optimism bias and social pressure, allowing for a torrent of honest, critical feedback. People will identify risks they would have never mentioned in a standard planning meeting. They'll point out potential personality clashes, flawed assumptions, and external threats. The pre-mortem is inversion as a leadership strategy. It's a formal process for harvesting the disconfirming evidence from a team's collective intelligence before a single dollar is spent or a single hour of work is wasted. It is the practical application of Munger's wisdom to figure out where you want to go. First, figure out all the places you absolutely don't want to end up, and then just make sure you don't go there. This powerful philosophy of inversion can be systematized into a practical mental model that you can apply to your most important decisions. Let's call it the Failure Manifesto. This isn't a business plan. It's a pre-mortem for your goals, a detailed map of all the icebergs your ship might hit. Here is the 4-step blueprint for creating your own. Step 1. Define success with ruthless clarity. You cannot map the path of failure if you don't know the destination you are trying to avoid failing at. Be specific and quantifiable. Don't say, "I want this investment to do well." Say, "My goal for this investment is to achieve a 15% annualized return over the next 5 years, with a maximum drawdown of 20%. Don't say, "I want our new product to be successful." Say, "Success for this product is defined as capturing 10% market share and achieving a 25% gross margin within 24 months. This clarity is non-negotiable. Step 2. Brainstorm the apocalypse. This is the core of the exercise. With your clearly defined goal at the top of the page, you will now brainstorm and list every single possible reason this could fail. Think like a saboteur. Think like your worst enemy. No reason is too small, too outlandish, or too uncomfortable to write down. To structure this, break it down into categories. For an investment, you might have categories like market-level risks, e.g., recession, interest rate hikes, regulatory changes; industry-level risks, e.g., new disruptive competitor, changing consumer tastes; and company-specific risks, e.g., management incompetence, balance sheet weakness, product failure. For a business project, you might have internal risks, e.g., team burnout, technical debt, budget overruns, and external risks, e.g., supply chain disruption, competitor actions. The goal is to generate a long, terrifying, and exhaustive list. Step 3. Design tripwires and countermeasures. An unmanaged list of risks is just a source of anxiety. The next step is to make it actionable. For each significant failure point on your list, you must design 2 things. First, a tripwire, a specific, observable metric that will tell you if that risk is starting to materialize. For example, if a risk is, quote, new disruptive competitor, a tripwire might be, a new company in our space raises more than $10 million in venture capital. Second, a countermeasure, a pre-planned action you will take if the tripwire is hit. For the competitor example, the countermeasure might be, immediately launch a competitive analysis task force and allocate R&D budget to accelerate our next feature release. This turns your list of fears into a proactive risk management dashboard. Step 4. Your strategy is the navigation of the manifesto. This is the final, crucial mental shift. You must stop thinking of your plan as a path to success. Instead, view your strategy as the set of actions you are taking to navigate through the minefield you've just mapped in your failure manifesto. Your primary job is not to chase the upside. It is to mitigate the downside you have so carefully detailed. Success then becomes the natural byproduct of skillfully avoiding failure. When you operate this way, your decisions become more robust, more resilient, and far less susceptible to the giddy optimism that leads so many others astray. The Failure Manifesto stands in stark contrast to the path followed by the vast majority of individuals and organizations. The antithesis of inversion is the get-rich-quick or silver bullet mindset. It is a world built entirely on chasing the upside, with little to no thought given to the potential downside. This is the world of hype, narrative, and FOMO, the fear of missing out. Consider the cryptocurrency bull runs or the meme stock frenzies that have captured headlines. The entire conversation in these communities is structured around a forward-looking, success-oriented narrative. The language is about going to the moon, diamond hands, and life-changing gains. The focus is exclusively on the potential for explosive returns. The act of questioning the upside or raising concerns about risk is often met with hostility and ridicule. A person who attempts to apply inversion, who asks, "What are all the ways this could go to zero?" is not seen as a prudent analyst but as a heretic. What happens when you don't invert? You build a plan for a single outcome, success. Your entire strategy is predicated on a set of best-case assumptions holding true, but reality is messy and unpredictable. When a single one of those assumptions breaks, as it inevitably will, the entire structure collapses. The investor who didn't consider the risk of a regulatory crackdown is wiped out when the SEC announces a new rule. The startup founder who didn't plan for a key supplier going bankrupt sees their entire production line halt. They didn't just fail to plan for failure, their entire decision-making process was psychologically incapable of even conceiving of it. This is not a problem confined to speculative manias. It happens in the most respected corporate boardrooms. A company, high on its own success in one area, decides to make a massive acquisition in an unrelated field. The executive team, driven by ego and a desire for growth at all costs, builds a beautiful model showing all the synergies and accretive earnings. They ask, how will this make us a bigger, better company? They don't invert. They don't ask, what are all the ways this merger could destroy shareholder value, ruin our company culture, and distract us from our core business? The result is a long, sad history of value-destroying mergers and acquisitions, fueled by optimism bias, and a failure to think backward from the very real possibility of disaster. This is the path of the 99%. It is the path of building castles in the sky, without ever inspecting the ground beneath for fault lines. It is exciting, it is optimistic, and it is, more often than not, the direct road to catastrophic failure. The financial implication of embracing inversion is profound and direct. It is the operating system for what Buffett calls rule number 1 of investing, never lose money, and rule number 2, never forget rule number 1. This isn't just a clever saying. It is a mathematical truth about the nature of compounding. The avoidance of loss is more powerful than the achievement of gain. Let's look at the simple, brutal math. If you have a portfolio of $100,000 and you suffer a 50% loss, you are left with $50,000. To get back to your starting point of $100,000, you now need to achieve a 100% gain on your remaining capital. A single large loss requires a heroic gain just to break even. Now imagine two investors. Investor A is an aggressive, upside-focused investor. In year 1, she makes a 50% gain. In year 2, she suffers a 30% loss. Investor B is a conservative, inversion-focused investor. In year 1, she makes a steady 10% gain. In year 2, she also makes a 10% gain. Who is better off? Investor A's $100,000 grows to $150,000, then falls to $105,000. Investor B's $100,000 grows to $110,000, then to $121,000. Investor B, with her boring but consistent returns, is dramatically wealthier. Her focus on avoiding the large drawdown was mathematically superior. Inversion is the tool that enforces this discipline. By systematically identifying and mitigating the things that can cause large losses, you are directly protecting your capital base. You are ensuring that the engine of compounding continues to run smoothly, without the catastrophic setbacks that force you to start all over again. This manifests directly on a company's balance sheet and income statement. A business that uses inversion in its capital allocation decisions will have a much higher return on invested capital, ROIC, over time. Why? Because it avoids the disastrous projects. It doesn't build the factory in a politically unstable country. It doesn't make the overpriced acquisition. It doesn't launch the product that hasn't been properly vetted. By saying no to the high-risk, low-probability bets, it preserves its capital for the truly high-conviction opportunities. This leads to a cleaner balance sheet, higher margins, and more durable cash flows. This is the secret to long-term wealth management and the achievement of financial freedom. It is not about finding the one magical investment that will make you rich overnight. It is about building a robust process, a system of thought that protects you from your own worst instincts and from the inevitable storms of the market. It is about understanding that the tortoise, with his inverted focus on simply not falling into the ditch, will almost always beat the hare with his myopic focus on the finish line. Inversion is the shell of the tortoise. We have now established two foundational pillars: the discipline to fight our own confirmation bias and the philosophical commitment to inversion. However, these are still primarily internal, individual practices. To make this system truly robust, especially within an organization or a team, we must externalize it. We must build a process that forces dissent and formalizes the search for disconfirming evidence. This leads us to our third pillar: building the red team, the devil's advocate protocol. It is not enough to simply play devil's advocate inside your own head. You must create a culture and a system where others are empowered, and indeed required, to do it for you. This protocol transforms the abstract idea of intellectual honesty into a concrete, repeatable business strategy. The quintessential story of this principle in action within Berkshire Hathaway is the one that fundamentally transformed the company's entire trajectory: the purchase of See's Candies in 1972. At this point in his career, Warren Buffett was still a cigar-butt investor, a student of Benjamin Graham. He looked for statistically cheap companies, often mediocre businesses trading at bargain prices. He was looking for a good price, not necessarily a good business. When See's Candies came up for sale, his initial analysis, filtered through this cigar-butt lens, was that it was too expensive. The company was being offered for $25 million, which was 3 times its book value. To the Buffett of 1972, this was heresy. His first conclusion was no. This is where Charlie Munger played the role of the institutional devil's advocate. He was the red team. Munger advocated against Buffett's own core belief system. He argued that Buffett's deep-seated aversion to paying a premium for a business was, in this case, a mistake. He forced Buffett to destroy his most cherished idea: that price was everything. Munger presented the disconfirming evidence. He pointed to the incredible brand loyalty See's commanded. He talked about its pricing power, the ability to raise prices year after year without losing customers. He articulated the concept of a truly wonderful business with a durable competitive moat being worth a premium price. He made the case that it was better to buy a wonderful company at a fair price than a fair company at a wonderful price. Their back and forth was a real-world implementation of the devil's advocate protocol. Munger wasn't just being difficult. He was systematically attacking the foundational assumption of Buffett's entire investment philosophy up to that point. He was forcing Buffett to confront the evidence that his old model was insufficient for this new type of opportunity. Buffett, to his immense credit, listened. He allowed his own best idea to be challenged and ultimately defeated. They bought See's Candies for $25 million. That single decision, born from internal debate and a willingness to kill a cherished belief, has been an unmitigated triumph. The initial investment has since returned over $2 billion in pre-tax earnings to Berkshire Hathaway, requiring very little additional capital. But its true value was far greater. The See's Candies purchase, forced upon a reluctant Buffett by his devil's advocate partner, rewrote the source code of Berkshire. It was the gateway to their later massive successes with companies like Coca-Cola, American Express, and Apple. It shifted their focus from cheapness to quality, a move that made all the difference. This historical turning point was not the result of a lone genius having a flash of insight. It was the result of a system, in this case, an informal partnership, that allowed for and encouraged rigorous intellectual combat. It was the red team in action. The reason a formal devil's advocate protocol is so critical, especially in a group setting, is that it provides a powerful antidote to two of the most toxic social biases: groupthink and social proof. Humans are fundamentally tribal creatures. Our survival for millennia depended on our ability to cooperate and maintain social cohesion. This has left us with a deep-seated psychological aversion to conflict and disagreement within our own group. We want to be liked, we want to fit in, and we certainly don't want to be the sole voice of dissent in a room full of nodding heads. Groupthink is the phenomenon where a group of individuals reaches a consensus decision without critical evaluation of alternative viewpoints, driven by a desire for conformity. It's what happens when harmony is valued more than intellectual honesty. The classic case study is the Kennedy administration's Bay of Pigs invasion in 1961. A group of incredibly intelligent, experienced advisors all agreed that a covert invasion of Cuba was a good idea. In retrospect, it was a disastrously flawed plan. Why did no one speak up? Because a powerful atmosphere of consensus had formed around the charismatic President Kennedy. To dissent would have been to challenge the group, to appear disloyal or not a team player. The pressure to conform overrode critical judgment. A formal devil's advocate protocol is designed to systematically break this dynamic. It changes the social rules of the game. When you officially designate a person or a team as the red team, you are giving them the psychological safety and the explicit permission to be disagreeable. Their job, their duty, is to tear the plan apart. They are not being difficult, they are fulfilling their role. This fundamentally alters the group's dynamic. It signals that dissent is not just tolerated, but valued. It creates an environment where ideas are judged on their merits, not on the social capital of the person who proposed them. Social proof is a related bias where we determine what is correct by finding out what other people think is correct. If everyone in a meeting is nodding along with the CEO's new proposal, the immense psychological pressure is to assume they must all see something you don't, and so you nod along too. A devil's advocate short-circuits this. By presenting a well-reasoned, powerful counter-argument, they prove that consensus does not exist. They shatter the illusion of unanimous agreement, forcing everyone in the room to switch from social confirmation mode back to critical thinking mode. This is why the best leaders and executive decision-making bodies don't just hope for dissent, they engineer it. They understand that a decision that has not survived a rigorous good-faith challenge from an intelligent adversary is not a decision at all. It's a gamble. To move this from a historical anecdote to an actionable tool, we need a formal blueprint. Let's call this applied mental model the Steelman Summit. It's a structured meeting process designed to stress-test any significant proposal before it gets a green light. The name is important. The opposite of a straw man argument, attacking a weak, misrepresented version of a position, is a steelman argument, building the strongest, most formidable version of the opposing viewpoint. That is the goal of this process. Here is the 4-step protocol for running a Steelman Summit. Step 1. The written proposal. At least 48 hours before any decision meeting, the proponent of the idea, the person or team championing the new strategy, investment, or project, must submit their entire case in writing. This document should be comprehensive, including the core thesis, the supporting data, the projected outcomes, and the identified risks. This step is crucial because it forces clarity of thought and creates a fixed argument that cannot be changed on the fly during the emotional heat of a debate. Step 2. Designate the Steelman team. Once the proposal is circulated, a specific individual or a small team is officially designated as the Steelman team. Their sole responsibility is to prepare a case against the proposal. They are explicitly forbidden from making weak or easily refuted straw man arguments. Their mission is to understand the proponent's case so well that they can build the most compelling, data-driven, and intellectually honest counter-argument possible. They must argue against the proposal with more passion and rigor than even a true opponent would. Step 3. The formal debate. The meeting itself is not a brainstorming session. It is a structured debate. The proponent presents a summary of their case. Then, the steelman team presents their full counter-argument, the steelman case they have prepared. The remainder of the meeting is a moderated discussion, focused on dissecting the points of contention between the two cases. The moderator's job is to ensure the debate stays focused on evidence and logic, not on personalities or politics. The rest of the decision-makers in the room are primarily observers, listening to the strongest form of both sides of the issue. Step 4. The cool-down and decision. No decision is made at the end of the debate. This is a critical psychological cooling-off period. The emotions of the debate need to settle. The decision is made 24 hours later, either by the ultimate decision-maker or by a vote of the leadership team. The final decision is made only after the steelman argument has been fully heard, understood, and either successfully refuted by the proponent or deemed strong enough to kill the proposal. Implementing this protocol is a hallmark of a high-performance leadership strategy. It is an admission that no single person, no matter how brilliant, is immune to bias. It is a commitment to a process that values truth over ego and objectivity over consensus. The path of the 99% is the polar opposite of the steelman summit. It is the all-too-common corporate culture of the yes-man, a world where dissent is a career-limiting move. Let's paint the picture. A charismatic, powerful CEO walks into a boardroom. He's excited. He unveils his grand vision for a transformative acquisition. He presents a slide deck filled with optimistic projections and corporate jargon. As he speaks, he scans the room, making eye contact, his enthusiasm infectious. When he finishes, he asks, "Any questions?" There is a moment of silence. No one wants to be the first to speak. No one wants to be the skunk at the garden party. Junior executives look to their seniors to gauge the reaction. The seniors, knowing how the game is played, start to nod slowly, offering praise. "Brilliant, Bob. Truly visionary. This is exactly what the company needs." A cascade of social proof begins. To speak out against the idea now would be to brand oneself as negative, as not a team player, as someone who doesn't get it. The one person in the room who has serious doubts, a mid-level analyst who has seen that the target company has a toxic culture and declining organic growth, says nothing. The potential cost of speaking up, of challenging the CEO's pet project, is too high. The decision is approved unanimously. There was no steelman, there was no devil's advocate. There was only groupthink, ego, and social proof. This is precisely the dynamic that led to some of the most catastrophic corporate blunders in history. The AOL-Time Warner merger in 2000 is the textbook example. At the height of the dot-com bubble, executives at both companies were swept up in the narrative of creating a new media behemoth. The deal was celebrated on the cover of magazines. Anyone who questioned the astronomical valuation or the massive culture clash between the old media giant and the new internet upstart was dismissed as a dinosaur. The deal was a disaster of epic proportions, vaporizing over $200 billion in shareholder value and crippling both companies for a decade. It was a failure of vision, a failure of execution, and most fundamentally a failure of process. It was a decision made in an echo chamber, a boardroom of yes-men who lacked the institutional courage to build a red team and truly challenge the assumptions of a deal that looked too good to be true. This is the path of intellectual dishonesty, and it is paved with the bones of failed companies and ruined careers. The financial connection here is one of the clearest and most direct we will discuss. The implementation of a rigorous devil's advocate protocol like the Steelman Summit has a massive positive impact on a company's most important financial metric, return on invested capital, or ROIC. A company's job at its core is to take in capital from investors and its own profits, and deploy it into projects and assets that generate a return higher than its cost of capital. A company with a high and sustainable ROIC is a wealth-creating machine. A company with a low ROIC is destroying value. A formal red team process is a quality control mechanism for capital allocation. Think of all the ways a company can destroy capital. It can spend hundreds of millions on an R&D project for a product nobody wants. It can build a new factory that sits idle because the demand forecasts were wildly optimistic. It can make an overpriced acquisition that fails to integrate properly. Each of these is a capital allocation error. Each of these errors permanently lowers the company's overall ROIC. The Steelman Summit acts as a firewall against these errors. It kills the bad ideas before they can consume capital. The flawed R&D project is exposed in the debate and canceled, saving millions. The optimistic demand forecasts for the new factory are ripped apart by the Steelman team, and the project is scaled back or delayed. The hidden flaws in the acquisition target are brought to light, and the deal is scuttled. Every bad project killed is a direct financial victory. The capital that would have been wasted is now preserved. It can be returned to shareholders via dividends or buybacks. Or, even better, it can be redeployed into one of the rare projects that survives the brutal Steelman process, the true high-conviction ideas. Over time, this discipline creates a portfolio of projects and investments that is of a much higher average quality. The company makes fewer, better bets. Its ROIC climbs. Its stock price follows. This is how intellectual honesty on the part of a leadership team translates directly into tangible, quantifiable financial advantage for shareholders. It is the structural link between a culture of critical thinking and superior long-term business performance. We have now built a formidable system. We have a psychological awareness of our biases, a philosophical commitment to inversion, and an institutional process for challenging our own ideas. But there is a missing piece, a crucial boundary condition. This entire system of trying to destroy your ideas is only effective if you are operating in an arena where you are actually qualified to judge the evidence. A red team is useless if both the proponent and the devil's advocate are ignorant of the subject matter. This brings us to the fourth pillar, a concept that acts as a fortress wall around our decision-making process, the circle of competence. You cannot practice intellectual honesty in a field you do not understand. The first step to avoiding folly is to admit the boundaries of your own knowledge. The most famous demonstration of this principle is Warren Buffett's steadfast refusal to invest in technology stocks during the dot-com bubble of the late 1990s. As the market went on a speculative frenzy, with any company that had .com in its name soaring to absurd valuations, Buffett and Munger sat on the sidelines. Berkshire Hathaway's performance lagged the market. The media began to openly mock them. A famous Barron's cover story in 1999 was titled, "What's Wrong, Warren?" The article declared him a relic, a dinosaur whose folksy wisdom about moats and brands was irrelevant in the new digital age. The social pressure to join the party must have been immense. His own shareholders were questioning him. The entire world was telling him he was wrong. But Buffett's response was simple and unwavering. It wasn't that he believed all tech companies were bad investments. His position was more humble and far more powerful. He simply didn't know. He would say, "I have no idea where Amazon.com is going to be in 10 years, or Microsoft, or any of the others." He understood that because he didn't deeply understand the technology, the competitive landscape, or the business models, he was incapable of performing the rigorous analysis his system required. He couldn't destroy the investment thesis for a company like Pets.com because he couldn't competently build it in the first place. He had no edge. He was operating outside his circle of competence. His refusal to invest was not an opinion on the tech sector. It was an act of profound intellectual honesty about the limits of his own expertise. When the bubble burst in 2000-2001, and trillions of dollars of speculative wealth were vaporized, Buffett's discipline was vindicated. The dinosaur was revealed to be the wisest man in the room. He had saved his investors from catastrophe, not by being smarter about technology, but by being smarter about himself. He understood that the single most important part of problem-solving skills is knowing which problems you are equipped to solve and which you must leave alone. The circle of competence is the ultimate application of the Socratic paradox. The only true wisdom is in knowing you know nothing. Or, as Munger and Buffett would amend it, in knowing precisely what you know and what you don't. The circle of competence is a direct countermeasure to one of the most dangerous and embarrassing of all cognitive biases, the Dunning-Kruger effect. This is the well-researched phenomenon where people with low ability in a specific domain consistently overestimate their competence. The novice investor who has read one book on stocks thinks he's the next Warren Buffett. The manager who has taken one coding class thinks he can direct a team of senior engineers. In short, they are too ignorant to recognize their own ignorance. The Dunning-Kruger effect is a form of overconfidence bias that is particularly insidious because it is most pronounced in beginners. As one gains more experience in a field, one's assessment of one's own ability actually tends to become more realistic and humble. You start to appreciate the nuance and complexity. You learn how much you still have to learn. The circle of competence is a conscious, deliberate effort to bypass this dangerous initial phase of overconfidence. It is an act of preemptive intellectual humility. It requires you to sit down and honestly assess your own skills and knowledge, not based on your ego, but on your actual track record and depth of understanding. Our brains are not built for this kind of self-assessment. They are confidence machines. We are rewarded with feelings of certainty and pleasure when we feel we understand something, even if that understanding is shallow or completely wrong. The world is complex and ambiguous, and the feeling of not knowing is uncomfortable, akin to the cognitive dissonance we discussed earlier. To avoid this discomfort, we latch onto simple explanations and develop strong opinions on subjects we have barely studied. Defining a circle of competence is an act of rebellion against this instinct. It is the decision to become comfortable with the phrase, "I don't know." In a world that rewards hot takes and confident pronouncements, the ability to honestly say, "That's outside my circle, I don't have an opinion," is a superpower. It insulates you from the pressure to participate in manias and fads. It keeps your capital safe from your own ego. It forces you to only play games where you have a demonstrable advantage. It is the ultimate recognition that in the world of investing and business, the cost of unearned confidence is financial oblivion. This concept of a circle of competence can feel abstract, so let's translate it into a concrete practical exercise. This is a mental model we can call mapping your perimeter. It is a personal audit designed to draw a clear, bright line between what you know and what you only think you know. Grab a blank sheet of paper and follow these 4 steps. Step 1. Define your core. In the very center of the page, I want you to write down the handful of topics, industries, or skills where your knowledge is truly deep. The test for inclusion here is stringent. You should only write down a topic if you could confidently give a 1-hour lecture on it with no notes, or if you could hold your own in a debate against a genuine expert in the field. This is not about what you're interested in. It's about what you have mastered. For most people, this list will be surprisingly short. It might include the industry you've worked in for 20 years, a specific technical skill you've honed, or a hobby you've dedicated thousands of hours to. This is your core. Step 2. Draw the circle. Draw a circle around these core topics. This is it. This is your circle of competence. Everything inside this line is a potential area for high conviction decisions. This is your hunting ground. Step 3. The wilderness of ignorance. Now, in the vast space outside the circle, start brainstorming all the other topics on which you have an opinion or that you find interesting. This might include things like cryptocurrency, geopolitics in Asia, biotech drug development, macroeconomics. Be honest with yourself. These are the areas where your knowledge is shallow, second-hand, or based on headlines rather than deep study. This is the wilderness. It is fascinating to look at, but it is a dangerous place to wander. Step 4. The one great rule. Now write this rule at the bottom of the page. Major decisions regarding the deployment of my time, my reputation, and my capital can only be made on topics that lie completely inside the circle. For all topics outside the circle, my default answer is pass, or I delegate to a trusted expert. This map is your new decision-making filter. When a new investment opportunity or business idea comes your way, the very first question you must ask is, where does this fall on my map? If it's inside the circle, you can proceed to the next stages of our protocol: inversion, building a red team, and so on. If it's outside the circle, the process stops there. You pass. You don't get tempted. You don't allow your FOMO to trick you into believing you can learn it on the fly. You practice the discipline of saying no. This simple exercise, revisited once a year, will do more to protect you from catastrophic mistakes than any complex financial model ever could. The failure to respect the boundaries of one's own competence is the story behind countless financial tragedies. The antithesis of this discipline is a toxic combination of style drift and FOMO. This is the path of the 99%, the constant, restless search for the next shiny object, regardless of one's ability to analyze it. Let's take the example of a successful real estate investor. For years, she has diligently operated within her circle. She understands property management, local zoning laws, financing structures, and construction costs. She has built a small fortune by sticking to what she knows. Then, a new bull market in tech stocks begins. Her friends are all talking about the amazing returns they're making. She feels a powerful sense of FOMO. She sees others getting rich, and she feels like she's being left behind. She convinces herself that her success in one field, real estate, must mean she has a general talent for investing. This is a classic case of overconfidence bleeding from one domain into another. She starts buying speculative tech stocks based on news articles and tips from friends. She is now operating far outside her circle of competence. She doesn't understand software as a service business models, customer acquisition costs, or the competitive landscape of enterprise software. She cannot tell a truly innovative company from a well-marketed pretender. She is incapable of destroying the investment thesis because she lacks the tools to even build it. When the tech bubble deflates, she is wiped out, losing a significant portion of the wealth she so patiently built in her area of expertise. This story repeats itself endlessly. The value investor who suddenly decides he's an expert options trader. The manufacturing company that thinks it can pivot to become a software giant. The retail investor who, after one winning trade on a meme stock, believes they can consistently time the market. They all make the same fundamental error. They mistake luck for skill and venture into the wilderness without a map. They fail to understand that competence is not a general trait, it is intensely specific. The skills required for success in one domain do not automatically transfer to another. The path of the 99% is to chase returns wherever they may appear, while the path of the master is to patiently wait for opportunities to appear within the small, well-defined area they completely dominate. The direct financial connection of this principle is about maximizing your risk-adjusted returns. The concept of risk in investing is often misunderstood. Risk is not volatility. Risk, in the Buffett-Munger sense, is the permanent loss of capital, and its primary source is making decisions on matters you do not understand. When you operate inside your circle of competence, your ability to accurately assess risk is at its peak. You understand the variables. You know the history of the industry. You can spot the subtle signs of trouble or opportunity that an outsider would miss. Because your risk assessment is so much more accurate, you can make large, concentrated bets when you find a truly outstanding opportunity with a wide margin of safety. This is how Buffett was able to invest 40% of his partnership's capital into American Express during the salad oil scandal. He was an expert in banking and insurance. The opportunity was squarely in the middle of his circle. His deep knowledge allowed him to have the conviction to bet big when others were panicking. Now, consider your decision-making outside the circle. Out there, in the wilderness of your ignorance, your ability to assess risk is effectively zero. You are not investing. You are gambling. You are relying on the opinions of others, on market sentiment, on hope. Any bet you make out there, no matter how small, is a high-risk proposition. Therefore, the discipline of staying within the circle has a dramatic impact on the character of your portfolio and the trajectory of your business strategy. It leads to a portfolio that is more concentrated, higher conviction, and paradoxically, lower risk. You make fewer decisions, but the average quality of those decisions is vastly superior. This discipline prevents the diversification that plagues so many investors, owning a little bit of everything and therefore having no real conviction in anything. It prevents the catastrophic, company-killing bets on ventures far from a business's core competency. It is the ultimate tool for capital preservation, and capital preservation is the bedrock upon which all great fortunes are built. It is the financial manifestation of the simple, powerful wisdom of knowing thyself. We have arrived at the final pillar. We have dissected our own biases, inverted our perspective, built a system for institutional dissent, and defined the boundaries of our expertise. The entire system we have constructed is a giant, powerful filtering mechanism. It is designed to kill 99% of the ideas that enter it. It is a furnace that incinerates flimsy opinions, wishful thinking, and unearned confidence. But what about the 1%? What about the rare idea that survives this brutal gauntlet? An idea that survives the hunt for disconfirming evidence, that withstands the pre-mortem of inversion, that holds up against a steelman challenge, and that sits squarely in the center of your circle of competence. This is no longer a mere idea. It has been transformed. This brings us to our fifth and final pillar, capitalizing on conviction, the financial power of true objectivity. After you have vigorously and honestly tried to destroy an idea from every conceivable angle, and it is still standing, what you are left with is the rarest and most valuable commodity in the world of decision-making: true conviction. This is where extraordinary returns are generated. The quintessential story of capitalizing on conviction is Buffett's investment in American Express in the winter of 1963. The company was facing a crisis that threatened its very existence. A client of its warehousing division, a company called Allied Crude Vegetable Oil, had perpetrated a massive fraud. They had secured huge loans using barrels of salad oil as collateral, but it turned out the barrels were mostly filled with seawater. When the fraud was discovered, Allied went bankrupt, and its lenders turned to American Express to make them whole, as Amex had certified the contents. Wall Street panicked. The market assumed Amex's liability would be catastrophic, far exceeding its net worth. The stock collapsed, falling nearly 50% in a matter of weeks. The consensus view, the initial conclusion of the entire market, was that American Express was going to zero. This is where Buffett began his process. The idea that the market was mispricing Amex was squarely within his circle of competence. He understood the financials of credit and liability. He began by inverting. How could Amex go bankrupt? It would happen if the scandal permanently damaged its core, highly profitable businesses, the traveler's checks, and the charge card. If people and businesses lost faith in the Amex brand, the company was finished. So he didn't just look at balance sheets. He went out to do the work of actively seeking disconfirming evidence. He set out to prove himself wrong. He went to restaurants and travel agencies around Omaha. He talked to cashiers and managers. He asked them if they were still accepting Amex cards and traveler's checks. He observed customer behavior with his own eyes. He then went to the banks, his competitors, and asked them if they were seeing any drop-off in the use of Amex products. The evidence he found was overwhelming. Not only was the core business unaffected, but people and businesses were actually leaning more heavily on the trusted Amex brand in a time of uncertainty. The salad oil scandal was a problem for the warehousing division, but it was a non-event for the real money-making engines of the company. He had vigorously tried to destroy his own thesis that the core business was sound, and he had failed. the disconfirming evidence simply wasn't there. What remained was not an opinion, not a guess, but a rock-solid, evidence-based conviction. And with that conviction, he acted decisively. He invested 40% of his partnership's entire capital into American Express stock. It was an incredibly concentrated, high-stakes bet. The investment quickly became a massive winner, and it cemented Buffett's reputation as a brilliant investor. But it wasn't magic. It was the result of a process of relentless skepticism aimed at his own ideas, which, when an idea survives, leaves behind the pure, unshakable conviction required to bet big. The psychological state of having a true conviction is fundamentally different from simply holding a strong belief. A belief is often an emotional attachment to an outcome. It is fragile. It needs to be protected from contradictory information. When a belief is challenged, our ego gets defensive. We feel attacked. We retreat into our echo chambers to have our belief reaffirmed. A conviction, on the other hand, is born out of the intellectual equivalent of a trial by fire. It is not an emotional attachment. It is a probabilistic conclusion based on a rigorous assessment of evidence from all sides. Because it was forged in the fires of dissent and disconfirmation, it is not fragile, it is anti-fragile. It doesn't fear new information, it welcomes it. The person with a true conviction has already grappled with the best arguments against their position. A new piece of negative information is not a threat. It's just another data point to be analyzed and incorporated. This is the essence of a scientific Bayesian approach to thinking. In Bayesian reasoning, your confidence in a hypothesis is not a binary true or false. It is a probability, a percentage of confidence that you constantly update as new evidence becomes available. A piece of confirming evidence might move your confidence from 60% to 70%. A piece of disconfirming evidence might move it back down to 55%. The entire Buffett-Munger system we have been discussing is an aggressive, industrial-strength version of Bayesian updating. The goal of seeking disconfirming evidence, of inverting, of running a red team, is to throw the strongest possible negative evidence at your hypothesis as quickly as possible. This process rapidly polarizes your conclusions. Most ideas, the weak ones, will see their probability of being correct quickly plummet towards zero. You discard them and move on. But the rare, powerful idea that survives this onslaught will see its probability of being correct climb rapidly towards 100%. This is the mental state that allows for decisive, courageous action when your confidence is at 95%. Based not on hope, but on a brutal vetting process, you are no longer making a bet, you are acting on a near certainty. This is the psychological power of true objectivity. It is a quiet confidence, free from the bluster and ego of mere belief. It is the peace of mind that comes from knowing you have done the work, that you have faced the worst arguments against your idea and have emerged on the other side not just unscathed, but stronger. To operationalize this final step, to ensure you are acting on true conviction and not just strong belief, we can create a final checklist. This is the last gate an idea must pass through before you commit significant capital or resources. We will call it the conviction scorecard. It is a simple scoring system from 1 to 10 on 5 key factors for a total possible score of 50. You must be brutally honest in your self-assessment. Step 1. The thesis clarity. On a scale of 1 to 10, how simply and clearly can you articulate the core idea? Can you explain it to an intelligent person in 2 minutes and have them understand it completely? A 10 is an idea of beautiful simplicity, like Coca-Cola sells sugar water with a powerful brand. A 1 is a convoluted mess of jargon and dependencies. Score your idea. Step 2. The inversion test. On a scale of 1 to 10, how thoroughly have you mapped out the failure modes? Have you created a detailed failure manifesto? Do you have tripwires and countermeasures in place for the most significant risks? A 10 means you have a comprehensive, written pre-mortem. A 1 means you have only thought about the upside. Score your idea. Step 3. The devil's advocate test. On a scale of 1 to 10, How well did your idea survive a formal challenge? Was it subjected to a steelman argument from an intelligent, unbiased party? How strong were the counter-arguments? And how effectively were you able to refute them with data and logic? A 10 means your idea won a decisive victory in a rigorous debate. A 1 means it has never been challenged by anyone but yourself. Score your idea. Step 4. The Circle of Competence Test. On a scale of 1 to 10, how squarely does this idea sit within the very center of your circle of competence? Is this a field you have mastered, or is it on the periphery of your knowledge? A 10 is your core area of deep expertise. A 1 is a topic you just started learning about. Score your idea. Step 5. The disconfirming evidence search. On a scale of 1 to 10, how aggressively and honestly did you search for evidence that would prove you wrong? Did you spend as much or more time seeking out the bear case as you did the bull case? A 10 means you conducted an exhaustive search for contradictory views. A 1 means you spent all your time in an echo chamber. Score your idea. Now, add up your score. A total score below 40 out of 50 indicates that you do not have a true conviction. You have an opinion, a hunch, or a hope. You must not commit significant capital. You must either do more work to raise the score or discard the idea. A score of 40 or above indicates that you have done the required intellectual work. You have earned the right to act. This scorecard is the final governor on your decision-making process, the last defense against emotional, impulsive action. The antithesis of this conviction-based approach is the most common strategy in the world of finance and management: diversification. This term, coined by legendary investor Peter Lynch, describes the practice of spreading one's investments or resources so thinly across so many different areas that the overall result is mediocrity. Why do people do this? Because they lack true conviction in any single idea. An investor who hasn't done the rigorous work of trying to destroy their ideas is fundamentally unsure of everything. They buy a little bit of this stock, a little bit of that one. Their portfolio might contain 50 or 100 different positions. They are essentially admitting that they have no idea which of their ideas are actually good. They are hoping to get lucky. They are substituting broad diversification for deep analysis. The same is true in the corporate world. A CEO who lacks conviction will hedge his bets. The company will launch 10 different small initiatives, hoping one of them works out, instead of focusing its resources on the 1 or 2 big ideas that have survived a rigorous vetting process. This is a recipe for guaranteed mediocrity. Your results will, at best, mirror the average of your industry or the market, minus the costs of all that frenetic but unfocused activity. You have diversified away the risk of total failure, but you have also diversified away any chance of spectacular success. This is the path of the 99%. It is the safe, comfortable, and ultimately unrewarding path of the committee, the consensus, and the cover-your-backside decision. It is a world without conviction, and therefore, a world without the potential for greatness. True genius in investing in business is not about having more ideas than anyone else. It's about having a few truly great ideas and having the courage, born of rigorous intellectual work, to bet heavily on them when they appear. This brings us to the final, direct financial connection. The entire system we have deconstructed, this 5-pillar machine for killing bad ideas, is ultimately a justification for the single most powerful strategy for wealth creation: the concentration of capital. The reason Berkshire Hathaway has been able to compound wealth at a rate that has defied financial gravity for over 50 years is that when they find an opportunity that scores a 50 out of 50 on the conviction scorecard, they don't just dip a toe in the water. They back up the truck. They bet big. Their portfolio is not a widely diversified index fund. It is a highly concentrated collection of their absolute best, most rigorously vetted ideas. Think about it. The process is a funnel. At the top, hundreds of potential ideas come in. The filters of circle of competence, inversion, and the devil's advocate protocol eliminate the vast majority. What comes out the bottom of the funnel is a tiny, precious handful of true, high-conviction opportunities. It would be illogical to then take these golden ideas and allocate the same amount of capital to them as you would to 100 unvetted maybes. The process itself demands concentration. This is the ultimate connection between this mental model and extraordinary financial success. A portfolio of 5 to 10 ideas that you understand deeply, that have survived every attempt to destroy them, has a vastly higher probability of generating massive outperformance than a portfolio of 100 ideas you barely understand. This is the secret of the world's greatest capital allocators, from Buffett and Munger to the top minds in private equity and venture capital. They don't spread their bets, they focus their bets. Their edge is not in finding more ideas, but in having a superior process for validating the few that matter. This is the ultimate financial payoff for the difficult, uncomfortable, and deeply unnatural work of trying to prove yourself wrong. It is what allows you to move from the world of incremental gains to the world of transformational wealth. You have just spent this time acquiring a powerful mental tool. You have absorbed a framework that separates amateur opinion from professional conviction. The discipline of actively seeking to destroy your own best ideas is the furnace that forges true intellectual honesty. It is a system for overriding your own flawed biology, for silencing the siren song of confirmation bias, and for building decisions on a foundation of unshakable objective truth. This is a weapon that will serve you in every high-stakes decision you ever make. But this weapon, this furnace, is only as powerful as the raw material you feed into it. The ability to destroy an idea is useless if you can't find the world-class ideas worth testing in the first place. The framework we have just built is the testing ground, but what about the search? How did Buffett and Munger identify See's Candies or American Express or Coca-Cola as ideas even worth putting into the furnace, while ignoring thousands of others? That is the missing link. It is the other half of the map. It is the system for generating the opportunities, which must then be subjected to the system for validating them. The video that YouTube is now showing you on the screen is designed to be the next piece of that puzzle. It holds the key to the filtering mechanisms and the mental models that surface these world-class opportunities from the noise of the market. The choice to click is not about watching another video. It is a declaration. It is a commitment to moving from being someone who merely has ideas to someone who builds an arsenal of unshakable convictions. You have built the furnace. Now it is time to learn how to find the ore, continue your journey, complete the model, click the video,